My name is Natasha Panjwani, and welcome to our new series, SF Conversations. I'm joined by Dan Chambers, who leads the transportation and digital infrastructure efforts on our team, and I primarily focus on new assets. Today, we are going to have a brief conversation about the areas we cover and the trends we're seeing in the industry. So let's get started. So Dan, what are we seeing in transportation?
Transportation is becoming very active recently. There are several new issuances that are starting to come out, and you expect to see us rating those. I think what you're seeing in terms of trends in the market is, limited new supply for aircraft means values are going up and older planes are staying in circulation. Has positive effects on value, has positive effects on deals, and you're seeing deleveraging. What you're also seeing is that because there's been a lack of issuance, that balance sheets and warehouse facilities are filling up. So we do expect to see a fair amount of robust issuance over the next several months. In terms of where we've been, we overhauled our criteria during COVID. We took a pause and to refresh the assumptions. So we have new criteria that we've recently rolled out. We've had lots of interaction with investors to get them comfortable with it and with issuers. So infrastructure is a big focus for where we are. We've developed talent on the team. We have industry expertise. We're well positioned in that space.
So Dan, thanks for talking about transportation. On the aviation front, a big focus of new assets since the pandemic has been airline loyalty programs. That was started because airlines needed a source of funding in trying times in the pandemic when they were burning a lot of cash. And so we developed this approach under our future flow criteria to specifically forecast and value these loyalty programs in conjunction with our corporate team. That's really kind of picked up since the pandemic in the sense, we have big high profile transactions with over 30 billion in issuance since the pandemic. And so that is kind of our start in the pandemic to open the doors for new assets and these like loyalty or royalty-like structures. Kind of with that being said, other areas of focus, I think since the pandemic or that have really taken off are digital infrastructure. Can you speak to that?
Yeah, one of the things about airline loyalty that I thought was amazing was the ability to get it done so quickly and develop the criteria to do that. I think having flexible, objective, intentionally objective criteria that allows you to be able to, anticipate what's going on in the market or to react to things that you maybe didn't anticipate. And so in digital infrastructure, the bread and butter of the asset class has been cell towers. And there's, robust issuance that's outstanding now. We don't see a lot of new issuers in that space, but we do continue to see taps under existing facilities. Where that market's been super active has been on the fiber side. There's been fiber to the home, fiber to the premises, different fiber to HOAs and condo associations. We see bulk fiber, small cell networks, and distributed antenna centers have also been a focus that we've seen recently. But super robust issuance there. M&A activity has put a question mark on how much gets done on the ABS side and where the leverage finance market participates. But it's been super active. So digital infrastructure has been very busy.
Thanks. That reminds me of, a little bit prior to the pandemic, we developed our approach to oil and gas proven developed producing assets as those lend itself to securitization, and these oil and gas companies needed kind of a different source of funding from traditional bank lending. And so that has really picked up in our group, and we have dedicated resources now that really focus on looking at these types of transactions. We've rated over probably 30 transactions totaling about $10 billion over the last 5 years. Most of it's been done in the private space, so we haven't been as vocal about it, but it is a big portion of our portfolio where even especially in 2024, we've seen actually a lot of activity and issuance in this space. We've seen new jurisdictions and new inquiries, so we're looking to make sure that our assumptions are, would remain appropriate or maybe have refined assumptions for new jurisdictions like Alaska, California, or even Canada. And not only looking at onshore assets, which we've been focusing on under this criteria, but offshore as well, because we do have expertise from emerging markets and looking at very concentrated oil and gas assets like floating production storage and offloading units.
Yeah, so That's a sector that didn't really exist a couple of years ago in terms of securitization. And I think, from the energy side, you begin to see the other elements in that. Maybe oil tankers, for example, is something that we've seen. When you're looking at PDP and oil wells, you're looking primarily at the asset, but we're looking at the influence of the sponsor and their ability to do that. Maybe you could talk a little bit about how tankers are a little bit different. It's a different approach to how we think about, while it's energy, it's a different rating approach.
It's a really good distinction to make, actually. So what we've seen kind of U.S. onshore that we have looked at with PDP assets, you have, for better or worse, you've seen a history of oil and gas operators kind of going bust and disappearing the next day. But what we've seen is that another company typically comes in because you have a molecule in the ground that you can monetize. And so you have new companies that come in and take over and actually keep the field staff in place. And so you have actually the same people working on those assets. And so that lends itself to more traditional structured finance, which we see. And then you have assets like oil vessel, which are, FPSOs and shuttle tankers, like you mentioned, that are more concentrated, single asset or 1 to 2 asset transactions that are heavily reliant on the operator to generate that cash flow. If that operator is not around, it's hard to make the argument that that cash flow might be as stable because those assets specifically are built to suit for the field in question. And so we have kind of seen that spectrum. On another end, similar to PDP, but maybe even a little bit further removed, I feel like, since the pandemic, we've focused a little bit more on green energy. Can you speak to that?
Yeah, so I think you're referring to solar, and I think energy is a way to sort of think about how the group works. When you're looking at what's in the ground, it's a commercial transaction. You're looking at those assets. When you're looking at tankers, it's more of a credit-linked analysis. When we're looking at solar, because they're residential solar loans, it's much more of a consumer analysis. So our ability to pivot within that and have criteria that can cover those different sectors is super important. With respect to solar and the activity that we've seen there, it's been super robust for the last 2 years. 3 years ago, we really didn't participate in that space. There was a lack of operating history in terms of performance, and we were able to go through, update our assumptions and look at the available performance of existing deals to come up with rating assumptions that we were comfortable with. So since then, we've rated probably 30 deals, the 3 largest issuers in the loan space, and been super active there. I mean, future development, we have a long list of to-dos for the solar space, but part of it is expand our issuer base. Part of it is to look at lease and PPA transactions. Part of it is potentially C&I solar. And then at the same time, increasing our ability to, making our models and criteria a little bit more robust to handle these different things. So there's a lot of activity, on that side. So that's, a consumer asset. Maybe you could talk a little bit about some of the different things we're seeing on the new asset side and the different types of litigation finance or some of the other things that we're looking at that have a different predicate.
Yeah, I would say one big area right now that we've been focusing a lot of our attention on has been kind of music, IP, and media in general. That has really picked up over the last several years. I would say a lot what we've seen recently has been in the private space, but we've taken a look at several transactions that help us get comfortable with the asset, and also some of the trends we're noticing in some of the portfolios is that concentration or diversification is a very important topic on these portfolios.
You mean like how many artists are in the portfolio?
Yeah, it could be based on genre, artists, vintage as well, because there is a decline profile that we see with music in particular. With that being said, with music, we do see that as focused on a cash flow approach, less reliant on, say, the operator, but because there is some level of operational risks that still exists. But this cash flow approach is very important because, the more concentrated portfolios that we see, the more volatile we see some of the cash flows. And so, again, what our takeaway here is, we want to look at everything to make sure we understand the market fully. And so what we have tried to do is take a bespoke approach to every deal that comes through our door. And we want to make sure that we are aligning the risk appropriately.
Yeah.
You also mentioned litigation finance. I would say that's a big focus for us in 2024. We've seen that asset class exist, and it's something that we've wanted to participate in. And we've dedicated some resources and made an effort to really understand that asset class and refine our approach and our assumptions. And so we're currently focused on that, and we'd like to see that pick up going into 2025.
Yeah. Any other asset classes that you see as being, on the horizon?
Yeah, one of the big things this year and high in demand right now is kind of the private credit equity-like structures that we've been seeing. Not only have we seen that in like the new asset esoteric space, but I feel like some of the existing asset classes that we've been seeing. And so looking at those different types of structures when it's an asset we're already familiar with helps us get comfortable with these private credit transactions.
Right.
So that's been really picking up. So I think, we've covered transportation, digital infrastructure, energy on the solar and PDP side, and kind of new assets. I mean, I know our group covers a number of different areas, but hopefully this was, I appreciate you taking the time to
Sure, it's my pleasure. Yeah, a great conversation.
So thank you for joining us today. If you have any questions or would like to continue the discussion, please send us a note at the address on the screen. Thanks for watching.